Hello, Coldwell Banker team. Thank you for joining us today. First and foremost, our hearts go out to our colleagues, our friends, and their families who have been affected by the devastation of Hurricane Helene. And I want to extend our deepest thoughts and well wishes to everyone that's been impacted. And we're so grateful to those who have reached out with support and assistance. These type of events remind us what truly matters in life. And while we're going to discuss business and the real estate market conditions today, our thoughts remain with those who are in the process of rebuilding and recovering. And additionally, we want to send our sincere hopes for the safety of everyone in the path of Hurricane Milton. So please stay safe. I'm honored to be joined today by the founder and CEO of Altos Research, Mike Simonsen. If you're not familiar with Mike and his work at Altos, they are a great resource of market intelligence as they analyze every transaction and listing every single week. So without further ado, let's please welcome in Mike Simonsen. Mike, how you doing, buddy?
Great, Jason. Thanks. Great to be here.
Good. I appreciate your time and assistance. And I big fan of you and your analytics and data. And I think what's one of the most valuable pieces is you really package it up in an easy, digestible way to really process the information and the data, which can be overwhelming at times and complex at times. So really value what you do and for giving your time to the Coldwell Banker Network today. So I will turn the stage over to you, my friend.
Great. Well, and I think that's a great place to start, and as well as with your the comments on the hurricane. So at Altos, what we're doing is tracking every home for sale in the country every week, all the pricing, all the supply, all the demand, all the changes in that data, all the sales, the pendings, and then we bubble it up and do the analytics for every zip code in the country and for the national. And we're going to take a national view today. And we've got people from all over the country, I think, on the call. And we're gonna dive into some of the questions. What do we know about the market right now? I've got some slides. I'll go through the slides, and as we go, I think we have a chat that we can use for questions. What we'll do is there's a few things. As we're talking about the data, if we share them in the chat, and then I'll pause along the way. We can be a little conversational and dive in and explore. I also have, I think it's Amanda from the Altos team who is in the chat who will be able to share links. Sometimes I'm going to share a link about things that we might refer to, and if you want to click through and stuff, so we can use it to be a little interactive. I won't be able to talk and monitor the chat at the same time, so we'll use that interactive back and forth. Does that sound good, Jason?
Buddy.
All right, let's dive in. Before I dive into the data, one of the links I want to share is at Altos, we have a free ebook, How to Use Market Data in Your Real Estate Business. So as I'm talking about the data today, you'll see my charts and you'll see the stats that I refer to. And a lot of agents, when they're working with individual buyers and sellers, it can be tricky. It can be a little scary to talk about the data. So this book has scripts, and it has, examples, and so of the stats that I'll use today, they're covered in this book. So it's free. I recommend it. We'll put a link, I think, in the chat so that people can go download it. And that'll, it's all the data I'm talking about today. It's how to talk about it in your business. So we like to offer that to everybody who is on the call today. So before I dive in, go get that, and that bit.ly Altos ebook, or if you go to the Altos Research website, there is a link for free resources to download that ebook. Okay, there are a few big questions right now, and as I was putting this together, it's like the biggest thing on everybody's mind, especially for the people in this room, is our home sales finally going to recover? If so, when are they going to recover, and by how much? So what do we know about the changes in mortgage rates and how that's going to affect buyers and sellers? And we're more than 2 years in now, to 2.5 years into this market of really depressed home sales. And so can we finally see around the corner? These are the questions we're going to dive into today. I'll share what we know. and where we are and what we can see out into the future already. At the same time, there's a lot of questions about inventory. Inventory's been growing. Will it keep growing? Does it going to get too many so that suddenly, it's out of whack with supply and demand? And therefore, what are implications for pricing? Over the last couple of years, we had a dramatic decline in demand as mortgage rates rose. We had a dramatic decline in demand, but we did not have much of a decline, if any, in home prices. So what do we know now about prices and where are prices heading? And, when you think about, there are potential home buyers on the sidelines right now who have been assuming for 2 years that home prices were about to crater. And I'm just going to wait until home prices crater, and then I'm going to jump in. And so what do we tell these people? What data can we show these people? How can we incentivize action and really help them make wise decisions? That's what we're going to try to tackle today. We've got like about 45 minutes. We'll do questions along the way, and we'll also do some questions at the end. So let's start with the sales rate. This is a chart of the new contracts pending, new pending sales each week. Homes that are going into the contract process, into the contract pending process each week. And this is, we're looking at single family homes. So 61,000 new sales started this week for single family homes. That ticked down a little bit for the week. And when you look at it, each line here is a year. So you could see most sales happen in the middle of the year. And then by the second half of the year, they drop off again. The light color, the light red line here is 2022. And you could see 2022 was still at the end of the pandemic era. Rates were climbing, but any deals that, like if you were thinking about buying in 22, it got pulled forward into the first half of the year. And then the 22, that light line dropped off in the second half of the year. And in fact, in September of 22 and again in September of last year, we had mortgage rate spikes in September that really drove the purchase volume way down. And you can see the light red line took this big dive in September of 22. And so suddenly right now we've had 2 weeks in a row where the pending home sales are coming in above either of the last 2 years. And what's happened, of course, is over basically September, we had nicely dropping mortgage rates. And when rates fell from like 7% to 6.5%, we didn't see a lot of motion in new sales. But when they got closer to 6%, we could start to see a few signals of home buyer activity. Now, it's not a lot of purchases. It's only 61,000 in a week, and last week it was 63,000, but it's more than it was the last 2 years. And what this says to me is, while it's not like, hey, celebrate, we've got a bunch of, the roof is coming off here. We do have, what it says to me is that the headlines for home sales are going to start to turn positive because it'll be home sales are up as mortgage rates fell, and home sales are up over last year. They're up over the last 2 years. So I think you're going to start to see a little bit more positive news in the headlines when it comes to home sales in the fourth quarter. What's really fascinating, so that's what I wanted to start. Like, we can finally can we really start to see a little bit of sales growth? And, as I've been talking to folks around the country, and some of the folks here will probably be able to echo this. I know there's a lot. I was in front of an audience with the Housing Wire group last week, and maybe a half of that crowd felt like their transaction volume had been picking up in the last few weeks. Now, half of them, it was not picking up. I also got anecdotes about suddenly we saw a few multiple offer scenarios, which we haven't had all year. And so we could see a little bit more action happening as rates were getting closer to 6%. What's fascinating, so then is we look at the mortgages, the mortgage side, we can look at the purchase applications, so that the mortgage applications from the MBA, and that is now up 6 weeks in a row with those falling mortgage rates. And you can see again here, each line is a year. And now we've got 2 weeks in a row that have more purchase applications than last year. The first time all year where there's more purchase applications than last year. It's like trying to grow. And you can see in the beginning of October last year in the red line and the beginning of October in the light red line in 22, big drop-offs in purchase applications. You can really see where buyers were stepping back. They taking immediate steps back when rates spiked. That in September, October of the last 2 years, those were surprises. It went in 22, rates went from like 6 to suddenly 6.5 to 7.5. And last year was from like 6.5 to 8 in that period. And so what we've been having is like the opposite now. And so finally starting to see a little liftoff in that. So 6 weeks in a row, mortgage applications are up. That mirrors the Altos pendings data that we were tracking. And so you could start to see that a little better. Now, that's the last 6 weeks. What's happened in the last 6 days? Mortgage rates actually jumped. We had strong economic data, especially late last week. So rates went from like 6.1 to 6.2 to suddenly 6.5. And yesterday they were like 6.6. And so what does that mean? Does that like put the brakes on the whole, like this little bit of green shoots of homebuyer trend that we've had? So what we're looking at here is, I like this view. This is a view of 12 years of mortgage rates. Each dot in here is the average rate for a week. And so what you see are these two bubbles. There's a bubble on the left, and that bubble on the left is where we've spent most of the last decade, 4.5%, 4%, 3.5%, all the way down to 2.5%. That's where most of the mortgages were done in the last decade. In the last 2 years, it's this rightmost bubble. We had 6.5%, 7%, 7.5%, 8%. And as rates earlier this summer were at 7%, they were in the middle of this big bubble on the right. I was anticipating, do we get down to 6.5 and start to see some activity? What I observed was that 6.5 was not really enough to move the needle for buyers. But then through September, we got closer to 6%. And when we got closer to 6%, so at the left side of the rightmost bubble, we could start to see some of those sales activities starting to pick up. And then when we look at this, there's two ways we can look at this view. If we stay at we stay in the sixes, the low sixes, we can see some activity. If you get closer to that left side bubble, rates fall to 5%, then you'd see a lot of that activity unlocked. And so you can really see with this view where there's these two groups of like thresholds of activity. And we saw 2 weeks ago, we saw applications picking up, pending home sales picking up, but then suddenly we're now back at 6.5%. And so it remains to be seen how much momentum buyers have. Do they slow down? And what happens to rates from here? Is it a couple days at 6.5 and then we drift back lower? Or does more economic news come in strong? The bond market then rallies for that, the yields head up, and that drives mortgage rates up. That remains to be seen. I think what we learn is that as rates are pushing 6%, we can see finally some activity that we did not see any time this year. And rates really stayed higher longer than anybody was expecting this year. And so that has implications for buyers and sellers who are sitting on the sidelines. Like, when do they take action? And there are implications on Like, how many buyers will I have? Where am I going to price my home? Do I need to make a, do I need to make a full price offer, or can I lowball this? All of those things are really tied up in where we're in this threshold and right now. So if we're lucky, rates drift back down to 6%. We have a better fourth quarter than we've had in a couple of years, and that would position us well for the first quarter of next year. Before I dive into the next step in inventory, do we want to, any questions on the rates or anything like that, Jason, before we move on?
Hi, this is Kristen. A couple questions came in through the Q&A. One of them was, what resources do you recommend to stay informed about the market trends and changes?
Well, I, of course, recommend Altos Research. What we're doing is we track this market every week, and I actually do a video every Monday with the latest national data. And then to get your data, and you can go, if you go get that ebook, you'll see how you can talk about the data, how you use market reports to reach out to people, how we teach people how to go, like, you go into that listing presentation and you put the market report on the top of that stack and you say, well, we have your house listed. I'm going to put this in your inbox every Monday. If we watch the market cooling while we have your house listed, it's going to show up right here in this one number. I want you to watch this one number every Monday. And that way it's like, it's not me telling you the market's cooling. It's the data telling you the market's cooling. So it is, it's a very powerful, so we spend a lot of time doing that at Altos. And you can get a lot of ideas from that ebook, and also, watch, it's our YouTube channel, Altos Research on YouTube, and we publish that video every Monday.
Great. And one more question before we move on. How are rental markets performing compared to home sales? Do you want to comment on that now, or will you cover it later?
I can just comment real quickly now on rental markets. I don't have any rental market data in the presentation today, but annual rent gains are kind of like home price gains. They tend to move together. You might think that they move opposite, like if people aren't buying homes, they must be renting, and that would drive them up. But it turns out that that's not the case. They generally move together. Rents are basically flat year over year. There's a lot of rental supply that's come on in some of the big markets. But also, as we're doing things like we're moving less, so there's less migration going on right now. We're holding on to our jobs. And so those are driving both home sales as well as rental demand. So rental markets are generally flat year over year as well. And in the markets like Austin, Texas, which have been hardest hit in home prices, they're also the hardest hit in rents. So that's roughly what I can talk about rents off the top of my head.
All right, thanks. All right, you can move on.
Okay, let's go on to inventory.
Question for you, and this is relative to just consumer behavior. What do you expect would happen if there was a 5 in front of mortgage interest rates? The 30-year fix.
So a 5, I'll say it in a few ways. So in fact, we're looking at the inventory numbers here. And one of the places that we would see it is in inventory. So as a rule of thumb, higher rates create higher inventory, lower rates create lower inventory. And what happens is that lower rates stimulate demand faster than supply. And so we would start to eat up some of the unsold inventory. And you can really see that in this chart. So in this chart, each line is a year of inventory. Inventory starts lower in January, February. It usually peaks in September and then starts declining for the fall and then reset for the following year. And you can see in last year in September, we had a mortgage rate climb, the bright red line. Mortgage rates spiked in September and inventory spiked. Inventory didn't peak until the end of November last year in that red line for 23. Right now in 24, we probably got 3 more weeks of rising inventory through October before it starts declining for the fall. You've got the one line in here that drives down right in the middle of the year rather than climbing. That's 2020. And in 2020, we had dramatically falling mortgage rates and we had dramatically falling inventory. We started to buy everything in sight. And so we have the three lines at the top were pre-pandemic, the lines at the bottom were how much homes were for sale during and just after the pandemic. And now each year we're slowly improving. We've been slowly getting back to the old normal levels. And so if mortgage rates get into the fives, if they fall from 6.5 now down into the fives, let's say they hit the fives in January and the first quarter we're in the fives, I anticipate that inventory will fall fewer than the 2024 line. It would be tighter. We'd have more buyer competition, and we would that would put upward pressure on home prices. And sales would obviously pick up as well, but we drive sales faster than we do supply. And so what we're looking at, so there's 734,000 single family homes on the market right now. That's the dark line in the middle here. And there are 37% more homes on the market now than a year ago, nationally. In the Sun Belt states, it's more than that. So right now, Arizona has 70% more homes unsold on the market than a year ago. Texas is about 44% more. Florida is like 52% more. I think I actually have a slide on that in a sec. And so we've had 2 years of rising rates, and we've had 2 years of rising inventory. And so one of the things that the rising inventory allows us to do is more homes for sale will allow more sales to happen. And it'll allow us to, we've had a supply restriction in the last 3 or 4 years. There are not enough homes, and that actually kept a lid on home sales from happening. So we are forecasting that we'll end the year about 25%, 27% more homes. So like 650,000 homes at the end of the year, unsold single family homes. That'll compress a little bit with 23 because 23 was in this spiking mortgage rate environment. And if we're lucky, we're in an easing mortgage rate environment in the fourth quarter of this year. So it is a little bit, I'd say the inventory is a little bit higher than I expected it would be at this time of the year, a little bit more. And that I think is really because rates stayed higher for longer than I expected. And we didn't quite see, it just finally got there the last few weeks. So here's the state level view. So the percentage here is the percentage, how many more homes on the market now than a year ago? So there's Arizona. The redder the state, the more homes that are for sale. Every state has more homes for sale than a year ago. Much of the Midwest and Northeast is 14 or 12% more homes. New York has 12% more homes on the market now than a year ago. Most of the year, New York was fewer homes than 23. And what's happened here is you can really see the migration patterns. In New York to Florida, the Chicago to Arizona, the central to Texas, you can see the Sun Belt migration. And over the last decade, we build a lot in the Sun Belt, not a lot in the Midwest and Northeast, but that's okay because we have a lot of people migrating. We have a lot of people moving. In the last 2 years, that migration has slowed way down. And in fact, some of the places like Austin and Sarasota actually have had negative migration this year, like outbound migration this year. And so you have the construction states where that migration pattern has slowed. Suddenly there's a lot more inventory. And where it used to be outbound from Chicago, that outbound is slowed. So those people aren't selling their homes there and they're not buying them in Arizona. And so you can really see that why Illinois or Ohio or New York is still just now coming off the pandemic lows of unsold inventory. Massachusetts and Boston in particular had the strongest housing market for most of the year. and still, really later into the spring and in midsummer is still things like multiple offer scenarios, bidding wars and stuff on the best properties. But even in Massachusetts, it's 38% more homes are available now than a year ago. So that's starting to regulate a little bit. In other words, like a month ago, Florida was at 60% more than a year ago, and Texas was at 50%. So because inventory was climbing late last year, these are now moderating a bit. So by next year, it'll be more evenly read with slightly more homes for sale across the country. What it'll also mean, though, like Jason, if rates fall dramatically, if we get like lucky and rates fall dramatically, then you'll see a lot of these inventories will shrink and compared to a year prior. There are like 7 states that have more inventory now unsold than 2019 pre-pandemic. So Texas and Oklahoma and Idaho, Florida, like just a few of those key Sunbelt states have more homes unsold than before the pandemic. So back to normal levels of unsold inventory. Let's switch to the new listings and then we can pause for questions here. So there were 61,000 new single family listings this week. That's 4% more than last year. You can see the dark red line here for the year is still a lot fewer sellers each week than the gray lines, the number of sellers we used to have. And so what I like to look at the new listings volume each week is 2023 was the absolute bottom, fewest sellers, really tight market. We have had slightly more sellers all year, but not a lot of sellers. And by the way, this I showed the pending sales and I showed the inventory and these new listings numbers. These are going to fall with the next hurricane as well. So they ticked down this week because of Helene. But Helene really impacted like Western North Carolina, it impacted a little bit of Western Florida. This week, we're looking at things like as I understand, I'm hearing stories about like, as soon as that storm is named, the insurance companies are not writing contracts. So it's going to be hard to get any sales done in Western Florida this week. So, and in terms of new listings and new pendings. So I expect both the new listings number to fall and the new pending sales to fall. So those hurricanes may really throw a wrench into any growth story that we may have had. Like it could be a few weeks before things turn around there and we see what or maybe the spring before we can see what is available in places like Tampa and Sarasota on Western Florida. And I think that those are big markets and could have a big impact all the way through Orlando and even Jacksonville this week. So that's going to knock these down. The thing that I am paying attention to for the rest of the country, we watch the new listings level each week because we are interested in that question of like, if this is sellers have been holding back for 2 years, if they finally decide to sell and, hey, it's like, I want to unload this property, are there too many of them? And right, like I mentioned, there are buyers sitting on the sidelines who are waiting for this flood of sellers that are going to, like their Airbnbs that aren't making their rent or whatever. They've got a story about sellers that are going to need to sell their homes. And they're expecting this flood, and that flood would be too many sellers for the buyers, and therefore prices would decline. And in order for that to happen, we'd first need to see this dark line here start climbing above the gray lines of how many sellers we used to have. And so what I watch for every week is there any sign of a lot of sellers, a number of sellers that are going to get us out of whack with with supply and demand. And as you can see here, like that, we're still very few sellers. It's still way below the cluster of lines that are the old years, the pre-pandemic years. And so there's no signal anywhere in the data of too many sellers, like anywhere in the data. If rates, say that rates fall to in the fives, some sellers who've been waiting, maybe they feel locked in with their great mortgage rate, and now maybe fives, like it's close enough, I can sell. I've been meaning to go move to a bigger place or across town or whatever the thing I've been delaying. Maybe we see an uptick in that, and then the question is, does it go too fast? And that's the number I'll be watching. We haven't seen any signal that too much is coming. And in fact, I'd like to see, us get closer to the gray lines, the bigger space next year, because more homes for sale allows more homes to be sold, to be a much more robust market. I think will be more healthy. We're still in a very restricted, this post-pandemic era is still very restricted because so many people have those, 3% mortgages that they don't want to ever get rid of. So here's another way to look at what's going on right now. We can track, we track all the homes that are active market, and we can track the ones going into contract, and the ones that aren't are withdrawn. And so we can estimate the number of withdrawals across the country. And over the holidays, you have the most withdrawals, right? People take their homes off the market, like we'll try it again later in the spring. But then, of course, in the first and second quarter, that's when the most activity is. And then as the summer goes on, if you don't have your offer for your house, you can either cut the price or you can withdraw. And you can wait till later. So this year, the dark line for this year was above 22 and 23, more withdrawals all year long. There were people who were like, wow, we're not getting the price I wanted. We're not seeing the offers I wanted. We're like rates are still higher in July or in August, still higher than we were expecting. And then what happened when rates got close to 6%? In the last few weeks here, that withdrawal rate ticked down a little bit this year. And it's actually, this week was below the last couple of years. In 2022, September 2022, that was when rates did that second surprise. They were at like 6, and suddenly they're 7.5. And a lot of people at that time, that light red line, like that's when people are like, we're done, we're pulling way off, and everything slowed down. And so you can really see the opposite happening in the last few weeks. Now, suddenly two things are happening that are going to impact withdrawals right now. Rates jump back up to 6.5, and we have the hurricanes. And so there's a lot of listings in Western Florida they're going to go, we're done for now, and we're not going to list it. And they may go through that process of actually withdrawing, or they may just sit there for a while and not be officially withdrawn, but there's not going to be any activity. So those will get withdrawn in the fourth quarter. So those two things are going to happen, but it's a really fascinating, you can see the demand pick up. It's not great, but it pick up just a little bit in the last few weeks there as rates went down.
Mike, it's been interesting to read and listen to the narratives about rising inventory all year long. But what rarely is mentioned in there is the baseline was so low. So even though we've seen inventory rise, historically, we're still at, historically low inventory. And it's just been fascinating that, the headlines that at least I've read tell half the story and not, finish with, but the baseline was, as low as it's ever been.
Yeah. And that's right. And so you can see in our inventory chart, there's 3 lines here. Like it was not that long ago when there would be 1 million homes for sale in the middle of summer, 1.25 million homes unsold. And, there's 730,000 right now. on the market, and it's climbing. It's like the longer we have higher mortgage rates, the closer we'll get back to that old level. There's, people buy, and when you're holding a house at 6.5%, you're much more likely to resell it to buy the next one than if you're holding at 2.5%. Even if you're buying the next house, you don't want to sell the first one, so that inventory doesn't grow. So as the longer rates are higher, the more inventory will climb back up. And yeah, we're still, a third or 25% fewer homes unsold in some markets like Austin and, some of the Florida markets. Yeah, actually, a lot of times, like, you have more homes unsold now in Austin than actually you've had in like 15 years. So in Austin, it is true. Austin's a much bigger city than it was 15 years ago. So there's a lot of those going on, but there's more homes on the market now. And so, but Austin is not the country. And, in Chicago, it's barely off the pandemic lows. And so, and Rhode Island and places like that are barely off the pandemic lows. So yeah, there's a lot going on there. And it's why, as rates falling rates stimulates demand faster than supply. And so that could actually drive inventory lower again.
Right. Yeah.
I don't believe that a return to really low rates solves the lock-in problem. I believe it exacerbates the lock-in problem. If we have more people getting super cheap loans, like, they don't want to sell those houses either.
Right.
But multiple years at 6 in the 6s, that is what solves the lock-in problem. We have more inventory over time. So let's then jump ahead to projection. So this is how we project the rest of the year. The dotted line is a projection for the rest of the year. You can see the shaded gap there is how many more homes on the market than 2023, and that'll compress a little bit by the end of the year. So 655,000 homes. That's like 27% more than 23. That's a pretty big growth this year, and that's a big growth because rates stayed higher for longer all year long. The demand was slower. That caused inventory to build up. Some of the markets have a lot more. Some of the markets have just a little bit more than last year. But nationally, we'll finish up about 27% over. And then as of right now, we're forecasting 2025 to be another notch higher. But that also can be very rate and economy dependent. So we will revise that as we go through the year, and we can see that the actual sales pace is kicking in. So that's a forecast for where inventory will finish 2024. Let's switch into pricing. The single family homes asking prices. So this is looking at all the homes on the market. It's currently $440,000. And this is a fun chart because each line here is a year again. The dark line shows us it is actually unchanged versus last year. So if I walk into the market today and I say, what can I buy across the country? The median price is $440,000. We still didn't get back. The absolute peak was June of 22. And of course, the market peaks in June, right? The best inventory comes on in April, May, June. The prices peak in June. And then in the second half of the year, you either have to do a little discount if you want to sell before school starts, or you do a little discount before the holidays, and then that resets for the following year. So you get a normal peak in June and then a reset. You can see in the second half of 22, when rates were climbing, that's when the market was changing really quickly. And so home prices were dropping most quickly in August and September and October of 22. And so that 22 line finished lower. So right now we're even with 23. And this is the asking price. So looking around the country, essentially 0% home price appreciation across the country. Now we can also look at prices in terms of the new contracts. So this is the price point that people are paying. And that price point is $395,000 right now. And what we're looking at here is all year long, we've had about a 3 to 5% home price gain over 2023. And you'll see that in all the headlines that Case-Shiller says 5% home price gains. Fannie Mae will say that's what they've been looking. And in the late summer, as rates were staying stubbornly high, the prices we were paying was starting to curve down. But in the last 4 weeks, we've had climbing sales prices and so that's like the market got slightly more demand and suddenly people were paying slightly higher prices. The mortgage rates kicked down, so the payments kicked down. So I ended up paying slightly more for the house over the last 4 weeks. Now, I expect this is going to tick down in the next couple of readings because, again, the recent jump in rates of the last few days and because of the hurricanes. But this really surprised me of the last 4 weeks, how quickly buyers responded to cheaper mortgage rates. And I think that's a message for buyers who are waiting for a bargain. And I'm just going to wait till the rates come down because then I'm going to get a better deal. And yes, your payments will improve. Like that's not a bad strategy, except that we can also see very quickly demand pick up, and that can drive prices up. And contrast that to September of 22, when the rates spiked, we could really see prices being paid, took a big decline, 7% price drop in September of 22. We could see it very quickly with those mortgage rates climb. We could see it again in 23. And in the last few weeks, we've had the opposite true. And that really surprised me how quickly that happened on those home prices. I expect we're going to end the year. So the asking prices are 0% change from last year. This week, we're at about 5% price appreciation on the contracts. So there's your range, 0 to 5%. Maybe it's 3% by the time we end the year. Most of the year, this number's come in at about 3% home price gains. A few weeks ago, I was expecting to inch closer to 0. Like just barely positive for the year, but the last 4 weeks have been pretty positive on pricing. So home prices flat to up a little bit for the year. My expectation is another year of flat to up a little bit in 25. And in fact, this is kind of a good thing. It's a good thing because, we have an affordability challenge across the country. Home prices went up dramatically, then mortgage rates went up, and home prices have not come down. And that is create an obvious affordability challenge for buyers. One way to get out of that is not to have like a price crash, but to have multiple years of basically flat home prices while our incomes are climbing. So our incomes grow into the home prices, and that can help affordability. And so in a lot of ways, like a healthy market might allow us, like we could see flat home prices over the next couple of years, might be a really good thing for home buyers across the country. And if rates fell too far too fast, I think the opposite would happen. And then we'd be right back into our previous affordability challenge.
Absolutely. So I've got a question for you, Mike. I mean, so the Fed made a really big reduction, the first in years in September, right?
Yep.
But there had modest impact on mortgage rates because it was already baked in there because there'd been so much talk in advance of that. There has been talk about 2 more cuts in November and in December. Do you think the same will happen there in terms of little impact or influence on mortgage rates because they'll already bake those decisions in, or do you expect that there might be a more significant influence on mortgage interest rates?
So the first thing I'd like to say is that I don't predict mortgage rates. I'm not convinced anyone can. I've been wrong on mortgage rates for 30 years. So that's so start there. But what I can tell you is this. I can tell you a couple of things. One is that the 30-year mortgage is most tightly correlated to the 10-year yield. And the 10-year yield, while affected by the Fed, is also really affected by economic expectations. And last week, what happened was The jobs numbers came in surprisingly strong, and previous summer jobs were revised up. So it's like the jobs environment has been stronger than we knew. And so suddenly the people who buy and sell the 10-year were more bullish on the economy, and therefore that drove the 10-year yield up.
Yeah.
And so you can imagine that what happens in the next few months is that the expectations of rate cuts by the Fed are tied with expectations that the economy is cooling, that jobs are cooling, that inflation is finally coming down, like that, and the Fed has an inflation and jobs mandate. And so if they don't have to worry about inflation anymore, now they can worry about making sure jobs are good. But if the opposite happens and inflation picks up and jobs pick up again, then suddenly the expectations for the Fed cuts would go away.
Right.
And that would probably drive rates higher. So I think the important thing is that while broadly we expect over the next year, you could imagine the U.S. economy has been chugging along, and it kept rates higher for longer because it was expanding bigger than people expected. We've been talking about recessions for 2.5 years. We've been talking about a recession. And so it just kept defying expectations. So when we think about mortgage rates, like it could defy expectations again, and we could be in a situation next summer where we're sitting at, here we are, 6.5%, 7% again. And so, like I said, I don't predict rates, but I do know they could go to 6.5 or 7. They could go to the 5s, But after a few months here, like, there's all kinds of factors which we can't predict. There's wars, and there's, strikes, and there's like all kinds of things that we don't have any control over, any visibility into. And so what we can say is I can show you exactly what's going to happen to home prices if rates, now they're at 6.5, if they go to 7 by November. Like, you see this line here of the price drops in 22. I can show you exactly what's going to happen if rates go there again in 24. We saw that on the sales number as well. Home buyers were super willing to just take a step back and say, oops, rates went to 7. I wasn't expecting that. Looks like I'm going to wait till March, and they will wait. And so what I can tell you is that, and on the other hand, we can see exactly what was happening when rates got closer to 6. We could see the demand pick up. We could see our sales number pick up. We could see the mortgage applications pick up. We could see the prices pick up. And so all of those things, we can see exactly what was going to happen if rates do, if they go up, and we can see what's happening if they go down. I have one last slide here, which is the price reductions, and then we can do any final questions. I think it'll be terrific. We have, there are currently 40% of the homes on the market, this is single-family homes on the market, that have taken price cuts. There is you can see each year's curve, normal curve. There's price reductions peak in the fall, where you're like, well, it's still on the market now, late summer. I'm going to cut, maybe get some demand. Now I got to do one more price cut before the holidays. But then if it's not sold in the holidays, maybe I withdraw and I start next year. And so you get this normal curve of price reductions for the year. The dark line here is this year, and most of the year we'd had more price reductions. We had a weaker demand environment than we'd had in many years. There's like 10 years of data on this chart. You can see 22, we started with record few coming out of the pandemic, and then in April, May, June, and when you're working with sellers, using the price reductions is very powerful. And I mentioned earlier at the top of the thing where it's like you go into that listing presentation, you put that market report on the top of the stack, and you say, look, while we have your house listed for sale, we know that, we think that things are picking up, but if buyers are backing off, we're going to see more seller competition, and we'll start to see these price reductions tick up each week. And every market normal, about a third of homes take a price cut. Sometimes that's a seller that's fishing for offers. Sometimes it's, it's strategic. Sometimes it's accidental, but about a third take a price cut before they sell, 35%. So this year where it's around 40, that's a weaker market than normal. And, the pandemic 22, started here, started very hot, with only 15%. So a third of homes think they're overpriced, but only 15% have to take a price cut because some of those guys that were fishing got their offers. Then it suddenly changed. So as price reductions were climbing in 22, if you were listing a house in May of 22, I know exactly the advice I'm giving to that seller. I'm like, look, you want to get ahead of this wave. Look at this thing kicking up. You want to price this house right now because in August, if it's still on the market, we're really screwed. So we want to do this right now. And so that's the message there that, you can do with the price reductions. And it's very powerful. And by the way, while we have your house listed, you can see the 22 and 23 lines, those mortgage rate jumps, price reductions jumped too. And so if rates like now, they jump from 6 to 6.5, if they go to 7, we're going to see a price reductions kick up in October and November of this year as well. On the other hand, they've been flat for a few weeks because it's late in the year, but we've had better rates. So you can see that slight improvement in purchase demand because fewer sellers need to do price reductions here. So it's high. We can see the absolute level, but also the slope. How many people are cutting their prices each week? How fast this is changing can be very powerful. And what this is pointing to now, so I like the price reductions as a leading indicator of future sales prices. So house is on the market now, but if it doesn't get an offer, it does a price cut in late October, it gets an offer in November, it closes in December, you start hearing about that in January. But you can see right now who's doing price reductions. And so if we see price reductions kicking up now, and in fact, like we did in 22, so late 22, we had 43% of the homes on the market that had price cuts. And in a place like Phoenix, it was like 62% of the homes had price cuts in late 22. And that told us that the year-over-year home price reductions were the first quarter of 23. So the headlines were like, home prices are down. That was like March, April, May of 23. And by that time, the price reductions were low. So the real-time demand was showing us that was improving. So the headlines were 6 months behind what the price reductions data was telling us. And right now it's telling us it's not climbing dramatically yet, but it's high. So we haven't come out of the weak demand world yet, but it's not deteriorating from here. That's what we can see in the price reductions data right now. Okay, those are the slides we have now. We have a few minutes to take some last questions and wrap up.
Great stuff, Mike. Kristen, do we have any questions for Mike?
We do, and I have a question that I want to ask both of you. I'll start with Mike. So based on the data, what strategies should agents adopt to stay competitive? Any thoughts there?
Well, so the strategy that I like, that I'm going to recommend, is that you use the data in your communication. The data is as much as like they go, there are people out there who think this market is in free fall. Right? They think the market, they're like, well, homes are going to lose, they're losing 10 or 15% equity a year. I'm just going to wait. And so you say, look, that may happen, but there's nothing anywhere in the data of it actually happening now. Or they may say, there's a lot of homes on the market. They're not selling. I'm going to lowball this offer. And, what we do in the Altos data is we have price range segments. And so you use it you look at the market report and you say, in the price range you care about, it's a 25 days on market. Now, if you're buying $1 million house, it's 85 days. You could go lowball that one. But if you want in your price range, you're in the highest demand part of the market. So the strategy is to use the data in the communication and even just to say, here's the data. right? Just here it is. Like you don't even have to fill in the blanks that much, and just let them dive. Jason, you have an opinion?
No, I mean, I echo the same thing. The whole network is heard me say this, over and over and over again. I've maintained it for years. Data is our most valuable currency. And, I think the best real estate professionals are great storytellers. They're able to leverage the data, analyze it, interpret it, and then package it up to explain or tell a story so folks can make a really good informed decision about buying or selling. So I echo the same comments. A good friend of mine, a great producer in the Kansas City area, and I love how he presents himself to his clients. And he was a former Wall Street guy, but he presents himself as a financial advisor in the asset class of housing. And it's just really unique and different, but he just leverages the data, is a good interpreter of the data, and packages it up and sells a story in a way that folks can make really good buying and selling informed decisions. So I agree 100% with you, Mike.
I have one recommendation there. It's like when you have your market data and you're sitting with the customer or the potential buyer or seller, you say, are you a big geek or a little geek? Because if you're a big geek, I'm going to put this market report in your inbox and you're going to love it and you're going to dive in. If you're just a little geek, I want you to look at one number. Let's watch this price reductions number while we have your house listed. So even if you're just a little geek, there's like one, I just want you to look at one number, and that can be a really effective way to say, like, I'm the expert. I have the resources. I'm going to put it in your inbox every Monday. And I'm going to guide you through this, and you don't have to worry about like all the charts and the blinky lights and stuff like that. Just look at one number.
Well, you'll love this. I got a text in the middle of this from our good friend Ron Sweeney, runs a great Coldwell Banker in the Ohio area. Dude, I geek out on this blank, blank, blank. He's the best. Like him a lot. So there's a good testimonial there, but big geek in Ohio. So anyways, hey, listen, we're at the hour. Really appreciate your time, Mike. As again, I've maintained data is our most valuable currency. You gave us a lot today. If you don't follow Mike and Altos, I highly recommend you do that, and look forward to spending time with you in the future, Mike.
Jason, my pleasure.
All right, buddy. Take care.
Nice seeing everybody.
And so my final comments, Kristen, we're 1 week into the fourth quarter. This is the most important quarter from the perspective of ensuring a fast start to the first quarter of next year. So take the information today, digest it, process it, and let's put our foot on the gas pedal, finish the year strong, but more importantly, set ourselves up for a fast start in Q1. And with that, thank you for being here today and wishing you all continued success. Take care.